Retail giant Target Corporation reported results for the third quarter that underlined both resilience and concern in the U.S. consumer economy. While the company beat earnings per share expectations, its sales performance and outlook point to ongoing headwinds. Key retail metrics. 1. Target posted adjusted earnings per share of $1.78, beating analyst estimates of about $1.72. 2. Total sales declined by approximately 1.5% year-on-year to roughly $25.31 billion, just below Wall Street's expectation of $25.33 billion. 3. Merchandise sales were down about 1.9%, though non-merchandise, services, or other revenue streams rose sharply, about 17.7%. 4. Comparable same-store sales fell roughly 3.8%, while digital comparable sales rose about 2.4%. 5. Target narrowed its full-year adjusted EPS guidance to a range of $7 to $8, from a prior $7 to $9, but maintained a Q4 expectation of a low single-digit sales decline. What it tells us about the economy. The results highlight several important themes. Consumer softness/cautious spending. A decline in overall sales and same-store sales suggests that shoppers may be more careful, perhaps reducing discretionary spending or shifting habits. Shift toward non-merchandise revenue. The notable increase in non-merchandise sales, 17.7%, could reflect a strategic pivot by Target toward higher margin or service-based offerings, possibly in response to weaker core retail strength. Digital growth amid brick-and-mortar weakness. The rise in online comparable sales, plus 2.4%, shows digital channels remain resilient. But the drop in store sales indicates continuing pressure on in-person shopping. Careful outlook. Narrowing guidance suggests management sees more uncertainty ahead. A planned, low single-digit decline in sales for Q4 signals that Target doesn't expect a strong rebound just yet. Broader implications for retail and the market. Retailers often act as a canary in the coal mine for the economy. When they struggle, it may foreshadow broader consumer weakness. Target's mixed performance could imply that although some segments of spending remain healthy, digital, services, the traditional retail environment is under strain. This has implications for employment, supply chains, real estate, store closures or lower traffic, and other consumer-dependent sectors. For investors, the beat on earnings may provide some comfort, but the revenue miss and cautious tone may lead to increased wariness. Indeed, some market commentary noted that Target shares were losing ground after the report. What to watch going forward? Whether other large retailers report similar patterns, declining store comps, slower growth in merchandise, increased services/digital. Consumer sentiment, wage growth, inflation, and how they affect spending power. Target's execution of its strategy. Can they continue to grow non-merchandise revenue and digital sales to offset weaknesses elsewhere? How Target's Q4 results and full-year guidance evolve. Will the low single-digit decline turn into stable growth or worse? What this means for retail real estate, staffing, and the broader macro outlook for consumption. Conclusion. Target's Q3 performance is emblematic of a transitional moment in retail. With consumers under pressure, shifts to digital and services are increasingly important, while traditional retail strength fades. While the earnings beat is encouraging, the decline in sales and cautious outlook suggest caution is warranted not just for Target, but for the broader retail sector and by extension, consumer-led parts of the economy. How the company navigates its strategic shifts in the coming quarters will offer important signals for investors and economic watchers alike.